At a $1.75 trillion valuation, you're talking about 116 times price to sales multiple. That is crazy pants. NVIDIA is 35 times. And then your next closest defense contractor, Lockheed Martin, is 2 times.
From the Defense and Aerospace Report, this is the DownLink, a podcast about the intersection of space, the space business, and defense. Not just what's over the horizon, but what's happening above it. I'm your host, Laura Winter. 54. That's the number of years that have passed since humans have left Earth orbit. That last time was the 1972 Apollo 17 mission. That was also the last time humans walked on the moon. This episode is about money, the moon, and low Earth orbit. And as it's the beginning of the second quarter, we have the space and money guys. That's Chris Quilty, founder of Quilty Space, a financial research and investment banking and strategic advisory firm, and George Pullen, partner and chief economist at MilkyWayEconomy, a specialized advisory and investment firm that focuses on the emerging space economy. Now, on Wednesday, NASA launched the Artemis II mission. The Space Launch System rocket and Orion spacecraft lifted off from the Kennedy Space Center for a 10-day lunar flyby mission. As of this recording, the astronauts Reed Wiseman, Victor Glover, Christina Koch, and Canadian Space Agency astronaut Jeremy Hansen are traveling at roughly 6,225 kilometers an hour. That's above Mach 5. They are more than 175,000 kilometers from Earth. And here's the kicker. They're still not even halfway to the moon. They reached the moon's gravity well on Sunday before Monday's flyby. The Orion capsule is scheduled to return the 4 astronauts on Friday, April 10th. The Artemis II launch wasn't the only thing that happened on April Fool's Day. Elon Musk's space transportation and artificial intelligence company, SpaceX, it confidentially filed draft registration documents to the Securities and Exchange Commission. It's believed the company is targeting June for its initial public offering. For this episode, which will cover this IPO, I want to give you a little recent history on the valuation because it's kind of confusing. In January, Musk's private AI company was valued at $230 billion. Less than a month later, in February, SpaceX acquired that AI company. At that time, SpaceX suddenly valued itself as being worth $1 trillion and XAI as being $250 billion. That means in less than a month, the AI company's valuation jumped by $20 billion, according to SpaceX. Now, that means post-merger, SpaceX valued itself at $1.25 trillion. On Wednesday, April 1st, it was reported that SpaceX valued itself in the confidential SEC filings as being worth $1.75 trillion. That is the number used in this week's episode. But today, Friday, April 3rd, Bloomberg is reporting that SpaceX is asking banks to value the company at $2 trillion. From a basic search on Google, I only found one new government contract in the last 60 days. It's a Space Development Agency task order worth more than $178 million. That's with an M, for 2 Falcon 9 launches. Now, before we get to this discussion, here's a quick message for this episode's sponsor, L3 Harris. L3 Harris is the trusted disruptor in defense tech with customers' mission-critical needs always in mind. L3 Harris delivers end-to-end technology solutions connecting the space, air, land, sea, and cyber domains in the interest of national security. Learn more at l3harris.com. Now here's my discussion with Chris and George. Hey, Chris, George, it's great to have you both back on the DownLink podcast.
Thanks for having me back.
Laura, it's great to be back with you and George.
That's pretty generous of you, Chris.
Try my best.
All right, you two. So just last week, at the end of the quarter, NASA Administrator Jared Isaacman announced a major shift in the Artemis program. That's NASA's program to return astronauts to the moon and eventually to send them to Mars. And the hope of many is to spark a real cislunar economy along the way. There are really two big headlines. First is that NASA is going to the moon to do more than just plant boots and flags. The commitment is to build a lunar base, a permanent human-rated outpost. Now, that is kind of new, but it kind of fell to the side last year, so it kind of got resuscitated, right? That's big news. The policy says that robots will go to the moon and start that work next year. And in 2028, there may be up to 2 missions that put astronauts on the moon, ostensibly to further the outpost construction. That's a lot. And that's a very fast cadence. Now, and the second big headline is the deprioritization of the Lunar Gateway. That could be just a fancy way of saying that it will be canceled, but I'm not totally sure about that. But Gateway was supposed to be a space station that was going to orbit the moon and serve as a staging post for lunar surface operations. But here's the rub, right? The European Space Agency, ESA, the Canadian Space Agency, the Japanese Aerospace Exploration Agency, or JAXA, the UAE, all of them were counting on the Gateway as part of their participation in the Artemis program. And it was their way of getting their astronauts to the moon. Now, my sources tell me that they were caught off guard. And that's just the agencies. But there are also a number of U.S. and foreign space companies that are holding contracts for the Gateway. So this is, I'd say, a mixed result. Some companies will do very, very well, and others not so much. So I want you guys, since this news came out, it was about a week ago, I want you guys to tell me what you think the shape of things are now, today. And, you can do rock, scissors, paper and see who goes first.
George is pointing at me. So I guess I'll take the lead on this. I guess if anybody was surprised by the Gateway announcement, I want to play poker with them. Because this was so well telegraphed for so long that this was going to happen that I certainly wasn't surprised. And in fact, I've never understood the purpose of the Gateway. I mean, Wernher von Braun, back when he was white paper on how to get to the moon, threw away this concept. And I think the only reason we were doing it was they needed something so big that would fit on the SLS, so they had a way to justify the SLS because there was no other way to justify it. All that said, I don't think we're going to use this thing as target practice. There are other ways to repurpose it, and whatever. This thing's been going on for 5+ years. I'm sure the contractors have collected lots of good revenues and profits. Maybe they don't get the honey tail of maintenance over the next 20 years or whatnot, but I think the architecture moving directly to the moon is probably the smartest thing to do, just from a econ physics 101.
Well, let me jump in here real quick on you here, Chris. I want to bring up the whole $800 million acquisition that Intuitive Machines closed in January this year, right? They bought Lanteris, and Lanteris used to be Maxar. And back in the day, in 2019, they got a contract worth $375 million for Gateway's power and propulsion element, right? So that has to hurt, doesn't it, for Intuitive Machines? And I know their stock price has been a little rocky this week.
Yeah, well, I'm sure there were certainly, as with all Gateway elements, there were continuing future revenues that may or may not happen. Who knows? There may be fees from the cancellation for the convenience of the government that may make it more attractive. I don't know. But I would imagine, when the folks at Intuitive Machines were running the numbers on this, they weren't counting on this program to generate a lot of the incremental cash flow. They probably booked, by this point, 80 to 90% of the revenues under cost plus accounting. So, I don't think there's a huge loss there. And again, I think their rationale for buying it wasn't because they wanted to get into the, GeoSatcom market, which was historically, Space Systems, the RAL / Lantera / Maxar / Ford Aerospace, whatever the hell you want to call it. That had been their traditional business, and Intuitive Machines was obviously looking for a different capability in terms of setting up their lunar relay network, and it'll still work for that.
I was going to take a slightly different angle. I do like your poker comment. I do agree that I would love to play with whoever didn't see this coming, a few rounds of Texas Hold'em. But I mean, that being said, I worry that NASA has injected additional uncertainty here, because we've gone back and forth so many times about what it is we actually want to do next. And if this is a good pivot, which, by the way, I'll get to that. I think it could be a good pivot. I still worry that the market doesn't believe them, that this time's for real and this time we mean it, because that sort of uncertainty can, hold back investments. Now, I think if we look at it from the other point of view, then let's just call, NASA's pivot to the surface and a surface base what it is. It's a land grab, right? Someone looked at the orbital gateway and they said, okay, cool, orbital gateway, this looks great. We'll have this lunar toll booth, but if we want to have a surface base, that means there's going to be a flag in the dirt. And we realized, looking at the map, that if we stay in orbit, then China, completely gets to monopolize the $1 trillion water ice reserves.
Dollar. Yes,
the $1 trillion. There we go. I promise you, my tongue will work today. The $1 trillion, water ice reserves for the lunar South Pole, and you do that with boots, and you do that with flags, and you don't do that from orbit. So, I agree with the pivot. I just worry that because we've had so much jostling, that it's going to look like uncertainty to some people.
All right, but there actually is another part of this that I think is really exciting, and that is the possibility that we may have, astronauts or something landing on the moon every 6 months. At least that seems to be the indication that there's going to be a lot more launches going to the moon and a lot more activity. Now, George, I know that you have some portcos that have the word cislunar in them, which would make me think that this would be kind of exciting news for you. And Chris, I do remember you talking about a mutual friend of ours, a Manx, who wants to put data centers on the moon. So to have this kind of launch cadence, or at least the ambition to have that cadence, because we haven't heard this kind of ambition before, right? I mean, this is supposed to be 2 crewed landings in 2028. If we keep that up, could this start the cislunar economy? Could this be it? The door?
I think this could be an opening salvo. I don't think this is a door that we all get to pass through into the lunar economy of the future, as much as I'd like it to be. Because once we get up to, 2 missions a year, and let's say both of those missions are setting up robots for a while, and then another 2 missions a year a few years from now, and they're setting up people, and then some more missions setting up robots, and now it's, swarms of robots. I mean, things can start getting interesting, but there's a lot of both technology proof and, quite frankly, willingness of NASA to fund these things proof, because the commercial companies that are going up there are doing wonderful, efficient things under the contracting mechanisms that they have with NASA, but they're not going up there for each other, right? They're not buying and selling goods and services between each other and creating an economy. They're
It's
still
sort of
working as
a
contractors.
make-believe economy, rather.
Right,
It's a NASA economy.
It's a NASA economy.
But you have to start with a NASA
No,
economy to
it's
transition to a real...
That's right. It's a wonderful start, but I think we should just be open and honest that it's still a contractual relationship. It's still contractors doing an efficient mission, just demonstrating space technology that can lead to the next step. But there's no actual buying and selling of services at scale happening yet.
Chris?
So I'll take the opposite side of that bet, which is I will say that the twin effect of 185 billion or whatever the hell we call it going into Golden Dome, along with a Elon Musk, Jeff Bezos race to the moon, is going to drive a demand for the type of cislunar infrastructure, at first, right? So the people making the money are the people doing the picks and the shovels, doing the in-space orbital refueling, and you're going to assemble magazines of interceptors in space, and maybe it'll take some manufacturing, and okay, you kind of want to have space situational awareness, to know what's moving around out there, and hey, maybe we need a communication and a navigation system in order to be able to, move safely around this environment. And again, you've got Jeff Bezos and Elon Musk, the world's two richest men, throwing their personal wealth at beating each other to the moon. All that's a pretty good kicker for, if it ain't going to happen now, I don't know when it's going to happen. And the only caveat I'll give you is, I think the biggest challenge to all this happening, it's the same one when I started covering this industry 25 years ago. It's launch. It seemed like we had moved beyond that when you're talking about, SpaceX launching over 100 times a year. It's like, oh, we solved the launch problem. It's like, no, we've got a horrible launch problem today, supply-demand imbalance on the heavy lift side. And actually even on the small and medium, I mean, it's kind of Rocket Lab and everybody else has not yet scaled. So assuming that we can resolve the launch issue, a la Starship New Glenn, then yeah, I think then there's at least a 50-50 shot we get that cislunar economy.
All right. Well, also on that same day that the Artemis announcements were made, there was another major policy shift, at least telegraphed, right? And that is that NASA also intends to at least tinker with the Commercial LEO Destinations Program, or CLD. That is the initiative designed to develop privately owned and operated space stations in low Earth orbit, or LEO. This is to replace the International Space Station, and the clock is ticking here because NASA wants to deorbit the ISS in 2030. The CLD program has three main commercial actors: Axiom Space, Voyager Space, and Blue Origin. They lead teams, most of them. But the reaction from industry to that announcement wasn't warm. The head of the Commercial Space Federation told the House Science, Space, and Technology Committee that his members want to, quote, stick with the plan, unquote, and that the changes are, quote, sowing confusion, unquote. In fact, former astronaut Charlie Precourt was more blunt. He said there is a, quote, credible risk of a gap, unquote, in U.S. human presence in low Earth orbit. So is the risk real? How should investors react to these shifting policies? And this timeline, to change things around, it's kind of tight, right? I mean, 2030 is like tomorrow in space development terms, isn't it?
So the risk is very real. And this change is just increasing that risk. And the only option that we will have for the folks that want to do low gravity research in space manufacturing, research and development for pharmaceuticals, for high throughput optics, for advanced materials, for new types of chemical structures are being tested, is going to be, I guess I'll have to find my next best solution here on the ground. That will send a very negative signal to a future in-space manufacturing market, which was going to piggyback off of some of these commercial LEO destinations that are now drowned in this uncertainty. And yes, I think the infrastructure gap is very real, and I think it's incredibly problematic. I think if you look at, where MilkyWayEconomy, for example, has priced out the in-space manufacturing market into the 2030s, we've priced it at a $40 or $50 billion market. If you're talking about a $40 or $50 billion market, when you work backwards, that means that we have to keep on having this, 15 to 20% CAGR. Well, you're not going to keep that going if you have a gap. And, a few missed years here or there means that players are going to look for alternatives. They'll find them on terra firma. And then
Or China, or China's
Yeah.
Tiangong.
yeah,
I
I
mean,
didn't want
it's
to say
there
that,
and
but
it's flying. I know. I'm going to say it for you.
I mean,
then.
if I'm a commercial partner, I mean, am I going to really give up my IP like that? I tend to doubt it. But we might have partners and allies who do make those decisions, and then we're just putting our companies at a disadvantage because now they're going to be competing with companies that went that way, and we didn't. So yes, I think this is a huge liability.
Chris, thoughts?
Yeah, I mean, I agree. Right, there's been too much change too quickly with the program. When it was stood up 5+ years ago, there was sort of a path, and you kind of expect from administration to administration, they make changes, but the Trump administration came in, sort of changed the rules of the game. Looked like it was kind of stacked in favor of Vast, which they were on a path for doing a short duration, and that's what they were saying. And then, boom, 6 months later, here they are tacking it a different direction, right? So you don't get to do that. You don't get to do two change of directions, before one midterm, right? So, I would say I would love to. This is a capability that the government wants to see, and they need to stand up for their own purposes. But I would like to believe that this is a sustainable commercial business model. And I did a panel last month, and was on with the folks at Starlab, and they said they are fully sold out, for all their capacity on their initial configuration of the Starlab module. So that would tell you they're signaling to us that there is a commercial business model separate from the NASA and DoD needs. And there's at least, when you talk about 3, I think there's probably 5, commercial space stations, not including, right? You've got about a dozen companies like, either Varda or Inversion Space or the exploration company that are building capsules that say, yeah, if you want to manufacture stuff in space, you don't need to do it on this permanent platform. You can just launch it up and bring it down. So I think there's a couple of things going in the right direction. If I were NASA, geez, let's just settle on the capability we want, right? And not try to dictate the way to get there. Kind of like they did with the CLIPS program, right? They said, we want you to get this payload that weighs this much to the moon, and we'll pay you $90 million to do it. We don't care what you launch it on. We don't care what you land it on. We just care about the capability. And if they move towards more of that with the CLD, they would probably get a better outcome and some more original thinking, right? Because whereas, Vast has one view of how a space station should be built, Axiom has a very different view. And we won't know which one's the right model until these guys get on orbit and get to test it out.
Okay, George, Dr. Pullen, you're up. Quick and dirty. How is the economy?
Gosh, you want a quick and dirty on that? Okay. Okay. I think the name of the game here is what we're seeing in private credit right now. It's all over the newswire, or at least the types of newswires I follow. The private credit markets are not just a niche market anymore. They have been for a long time, but that's not the reality in 2026.
And who do they primarily serve, though? I think that's something that's misunderstood, because I think when people think of private credit, they're thinking about their private, personal credit card, if you see what I mean. Because the word private and credit go together, but that isn't what private credit is.
No. So
private credit, directly affects, I would think, your world very particularly, and possibly touches upon yours, Chris.
Yeah, so private credit has really grown into a $2 trillion behemoth. And private credit now acts, walks, and quacks a lot like a traditional banking duck does. And they lend money out from everyone to large commercial real estate players to deep tech firms and AI platforms. And so what this means is that as they've lent out this money so aggressively under such high demand signals since 2020, you've gone from a period of time where their coverage ratios, right, have gone from roughly 3 plus 3.4 was the old number, down to 1.5. So this is your EBIT over your interest payments. Okay, so EBITDA is EBITDA's cousin minus the amortization, right? So that means you're the
You're
amount of
hurting
money.
my brain, George. Be gentle.
Think of it this way, right? When you borrow to buy a home or buy a car, they want you to have a certain debt to income ratio. And when they give you that certain debt to income ratio, they say this is the most you can borrow, and then that's a snapshot in time. But then time moves forward. Well, when time moves forward in these private credit markets, the interest payments are variable, which means as interest rates go up, your payment went up. And if your earnings did not also go up, you're now making a bigger payment on potentially less earnings. That's a bad thing. That would be like if your debt to income ratio got worse over time and not better. Okay, so that's the equivalent here. The reason that matters is because in my world, what I see is a lot of folks will have PIK terms, right? And a PIK term is essentially when your interest is paid in kind over the course of the loan. But this causes a giant balloon at the end, even though it gives you a lot of free cash flow in the beginning, which is great for a smaller, medium-sized firm who doesn't have a lot of cash flow in the beginning. But the problem is, because the interest rates have gone up so much over these last 4 or 5 years, you're now hitting these debt walls where at the same time they're getting ready for a Series C or getting ready for a Series D. They have these huge debt burdens that they have to bear. And this isn't just happening in space. It's happening across the credit market. And as bankruptcies and defaults start to happen, people who participate in the lending side of private credit, who operate essentially like bankers now, are going to say, ooh, I have losses in this side of my portfolio. I have to adjust my risks. And what gets adjusted? Some of the more niche investments they might have had that were over in space and deep technologies, because they're like, ooh, I can't take those risks anymore because I have to rebalance my portfolio. So you could actually see credit drying up, even if space is paying all its bills.
And there's also another part of that, though, too, right? Because some of these folks that we're lending, folks as in individuals as well as, I'd imagine, institutional money, they would participate in this private credit. And as part of this rebalance and as part of understanding the economics of what you just explained, they've been wanting to pull their money out of some of these private credit funds markets. I'm not really sure, the right word for it. And
credit was really
and
cheap.
They've been told, sorry, we're keeping your money.
Yeah, credit,
right, and we'll give it back to you when we're good and ready. And that's kind of like wacky.
Yeah, credit was cheap and money was
not
everywhere.
A bank. That is definitely not a bank.
I mean, coming out of COVID, credit was cheap and money was everywhere. And in 21 and 22, the entire market gorged itself on it. And so now we have to live with the fact that we have bloated bellies.
Yeah. So maybe to back this up to the 20,000 foot level and put some context on it, private credit is something like, if you asked me 3 years ago, what's private credit? I go, I don't know. And I've been in the finance industry for, 30 years, but kind of like SPACs. Actually, we took Iridium public in a SPAC transaction in 2009. That was the first ever SPAC transaction. Most people
and it worked.
And it worked. But anyways, I put that aside. Nobody talked about SPACs right up until 2020, 2021, when SPACs, there were SPAC conferences and SPAC newsletters and SPAC. Yep. Same thing, private credit, it became this really hot thing. And like everything else, everybody overdid it. I got my private credit t-shirt, my private credit pens, and my private credit newsletter and private credit trips. And
I have my private credit hat on right now.
Yeah. And I mean, the other problem, right, with this as an investment vehicle, to your point, Laura, is it's not liquid, right?
Yeah.
These are private things. You can't just, sell them on the Dow Jones on a stock exchange.
Mm-hmm.
Somebody's got to sell a freaking office building if you want to get your money back.
Yeah. Or a bundle of IP that was used to lock up to do it. Yeah.
So, I mean, I'm not going to cry for these people. You knew when you were going into private credit, as an accredited investor, that this thing is illiquid and you're taking that liquidity risk. You're getting a higher premium because of it. But look, I mean, I've been invested in venture capital funds, which, you're supposed to raise the money, invest in for 2 years, then start getting it out years 5 to 7. And by year 10, it shut down. I have funds I've been in for almost 10 years where I've gotten no money out because of the environment we've been in with the market crash around 2001, 2002, and the liquidity and the IPOs, right? And that's how you exit. A venture investment is either an M&A or an IPO. And M&A, I'm glad to say, is starting to pick up a bit, but the IPO market still stinks because amongst all the things that the Trump administration has decided to fix, they haven't decided to fix Sarbanes-Oxley, which was
I also think
destructive legislation that ever since it's passed, it just doesn't make sense to go public because the costs and the regulation and the personal liability, introduced by that law, you'd rather be private.
Well, and the M&A activity that we are seeing that is potentially providing liquidity to folks, it's really just a vertical integration scramble for critical parts and components most of the time, or someone searching down their subcontractors who want a big offer, right, to complete something for Uncle Sam. It's not the old days, quote unquote, of M&A like you would have learned in your textbooks in the 90s or 2000s. It doesn't even look like that. And Chris makes a wonderful point comparing what we're hearing and seeing now in private credit to what we saw in SPACs, a few years prior. It's another one of these financial engineering instruments that's been around for a long time. It's always been a product out there, but it really got ahead of itself.
All right. So which way do we want to go, folks? Because we are running out of time, but I've got 2 really good questions. And you both teed both of them up. I've got kind of a changing market M&A sort of question, and I've got an IPO question. Which one are we going after?
It's dealer's choice. It's whatever you want to do, Laura. Chris, you can decide.
Yeah, I think we have to go the IPO route.
All right, let's do it then.
Simply because we're dealing with the biggest IPO in history.
That is correct, right? The Wall Street Journal reported this week that SpaceX is expected to confidentially file its initial public offering paperwork. That's part of the IPO process with the Securities and Exchange Commission, that's the SEC. And allegedly, SpaceX is targeting a June listing at a valuation of more than $1.75 trillion. That's with a T, folks. Trillion dollars. Just the reporting on that filing sent Rocket Lab and AST Space Mobile up 10%. Firefly was up just after this came out, this story. It went up 16%. So before SpaceX has even filed a single sheet or slide or what have you of its prospectus, it is already moving the sector, right? So, Chris, is SpaceX functioning as a valuation catalyst for the entire sector? And what happens when the actual S1, that's the formal registration statement, what happens when that drops and investors see the real numbers?
Oh, we already published numbers, so it won't be a surprise.
Well, not to you.
It'll be interesting to see. I think what everybody's going to find out is there's not as much in there as you'd like, right? I mean, I've been playing this game for a long time, and the way that companies and management teams choose to report their financials and their segment reporting is based upon, quote unquote, internal company management. It's like, how could we be least helpful to investors to actually understand what's going on? So you probably get like a SpaceX segment and an XAI segment. I don't know, right? We'll see. But, whatever. There's numbers once we get the S1, and, it's interesting that they're giving 30% of the shares to retail investors and whatever. You probably go to a bazillion.
Well, why is that interesting? Because I saw that reported as well, and I don't understand why that is interesting. I just know that people think that is interesting. Why is that interesting that 30% would go to retail? So that means 70% would be held by, I guess, the original investors.
Well, so here's what happens. I mean, under a normal underwriting process where the underwriters are paying, it used to be a big fat 7% fee to take somebody public. It's not 7% for SpaceX, but what would happen is the underwriter, in this case SpaceX, chooses the banks that they want to lead it. The banks are all then given allocations of how much funds they're allowed or how many shares they're allowed to distribute. And then each of those banks determine how they want to give it out. Now, if you're Goldman Sachs and you only have institutional clients, 100% goes to institutional. If you're my old employer, Raymond James, which has both institutional and retail investors, they're going to make the argument, to SpaceX, hey, we want a big chunk for our retail pot also. And there's thoughts around for a new stock that doesn't have an established trading, is it better in the hands of institutions that know how to handle it versus giving it to, retail investors that might under or overvalue it, blah, 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 blah. In this case, I think for SpaceX, all you got to do is look at AST Space Mobile, right? And the way that they have mobilized the retail investor behind that story and say, who has a bigger fan club, right? Elon Musk or Abel Avalon. And the guys at AST have done fabulous, right, of telling their story. But, I think in part, this is where if you're SpaceX, you want those retail guys, right? Because they're going to be enthusiastic and maybe a little, well, I don't think anybody here is necessarily attached to valuation, at $1.75 trillion valuation. But, regardless, you want that mix of folks who might be willing to pay more and others who, are going to trade around the stock. So historically, you don't see companies make that strong of a statement around how much retail distribution, but I it's generally probably less than 10%. I should know that number. I don't. That was a guess.
Well, shame on you for forgetting.
It depends on the type of deal, right?
George?
So I am much more perhaps concerned about this. So I see some things that could maybe go wrong, right? So if you look at, some of the revenue estimates that have come out over the years, and I'm not specifically saying to Chris's are obviously top notch. Some of the revenue estimates that have come out over the years, but, at a $1.75 trillion valuation, you're talking about 116 times price to sales multiple. That is crazy pants. NVIDIA is 35 times. And then your next closest defense contractor, Lockheed Martin, is 2 times. I can't find a way to get to 116 times unless I'm blindfolded. The next part is that when we look at what a $1.75 trillion IPO does, it's a macroeconomic sort of liquidity black hole because it's raising $50 billion in a very high rate environment, which means it's going to suck down institutional capacity that could be potentially going to other deep tech companies where you already have AI doing the exact same thing in a nearby sector. So I think about that. I also think about the way indexes are shaped. And for example, the S&P 500, it's weighted by market cap. And so because the S&P 500 is weighted by market cap, you're going to have a forced buying mechanism where people will have to balance and buy a lot of SpaceX. And SpaceX will now be part of millions of people's holdings. Now, that could be a case to keep the stock propped up. I'm not sure what the price to sales ratio does to prop it or push it back down. And I guess the last part is when we look at Starlink and what can do there, that's interesting. But I'm also really interested in, are there other earnings that are over there in Starshield, power arbitrage type things? Are there more earnings over there that become more transparent and make us feel better about this new defense prime going public? So I'm concerned. I'm going to be following closely the announcements, just like everybody else will be. But I'm holding out, and I'm not jumping in on IPO day.
Chris, George, thank you both so much for making the time to come on the podcast.
Thank you.
Always a pleasure.
That's it for this week. For your daily dose of award-winning defense coverage, listen to the Defense and Aerospace Report with Vago Muradian. And for the maritime domain, listen to Cavas Ships with Chris Cavas and Chris Cervello. And get your air domain news and analysis from the Air Power Podcast with JJ Gertler and Vago Muradian. I'm Laura Winter. Thank you for listening.